Okay, good morning everyone. Benjamin here. Welcome to today's weekly webinar. So today will be quite a long lineup of counters that we'll be going through, as well as during the later part of the presentation, I'll be going through Kim Heng, which we initiated 2 weeks ago. Alright, first up, I'll be going through SGX, UOB, and DBS. They released their earnings last week. So for SGX, released their full year results last week. So earlier this month, the start of July, when I gave a talk on SGX, we said that we expected a full year net profit about 320 mil and a full year revenue of 688 mil. So in our opinion, we expected a pickup in securities revenue because the securities daily traded average value, it recovered slightly in fourth quarter of this year. So on the other hand, the retail weightage has increased to about 67%. So retail investors usually pay more clearing fees. Therefore, we were of the opinion that securities revenue will pick up. All right, and if you guys have been following, as of 1st of June, the clearing fee structure has been revised as well. So there's no longer a cap on institutional trades. So we are talking about trades above 1.5 million. Right, derivatives volume has came down. So therefore, we expected the derivatives revenue to come down as well. So SGX has performed in line with our expectations for the full year results. Quarter profit is up 2% to 77.4 mil, and the full year net profit came in at 320.4 million. Right, so as of 1st of June, SGX introduced the market maker as well as liquidity provider program. So previously we were the opinion that this program will help, right, to boost liquidity as well as increase market depth and narrow the spreads. Right, but of course this is more in the long run, right, which we are optimistic that this should help to encourage more trade volumes. So in the near term wise, I think at such an infant stage, right, we are still there's not much visibility on how much this will take off. So the success really very much hinges on the number as well as the quality of the market participants that SGX will try to bring in, right? And if you guys saw the news at the end of last Friday as well, the board lot size has been finally confirmed to kick in January 2015, where it will be reduced from 1,000 to 100 shares per lot. Right, of course, along with some other proposals that MAS and SGX has confirmed, such as the 5% collateral that's required for holding a trade. Right, so some of the key repeating catalysts that we will see for SGX is sustained pickup in market volumes, increased number of IPOs, which we expect during the second half of this year, as well as taking off of new derivatives products that are launched. The full year dividend that they declared is 28 cents per share, same as last year. The payout ratio has increased to 93%, and the dividend yield is pretty attractive, slightly above 4% now currently at the current share price. Next up is UOB, right? Reported their second quarter net profit, 808 mils, up 2.5% quarter on quarter. So a bit of expectations slightly, right, on higher than expected loans and lower expenses. The thing is that their net interest margins actually fell 2 basis points Q on Q to 1.71%. Right, this is in line with our full year forecast. And management continues to see some margin compression to persist in the near future, especially from their overseas contribution side. So this quarter, earnings were not of very high quality because they actually recognized 190 to 100 mil of one-off investment income, which actually a part of it came from the disposal in UOL. Right, so credit quality still seems benign, right? But their non-performing loans actually went up about 10 basis points to 1.2%. Because a couple of accounts in Thailand and Singapore had some issues with the payment patterns. So, but for us, we don't think this issue is systemic across Singapore and Thailand, as we are not observing this in these competitors. So UOB, they're still focusing on broadening their funding base. Okay, so they are tapping into wholesale funding like commercial paper, especially those in USD. So these are short-term. Then the short-term nature of these commercial papers provides a better maturity as well as duration match for the short-term trade loans that they are underwriting. Right. On the individual side, we're still seeing some funding pressures as well as increasing competition for deposits. So we have revised our estimates slightly and pushed our target price upwards slightly to $24.10. Right, but currently the valuations are still looking a bit stretched. So our rating is still maintained at neutral. Hi, can you hear me? Hi, testing. Okay. Right, next up will be DBS. They announced their results last Friday, so this quarter was quite a good quarter for them. They delivered a quarter of high quality earnings. Right, net adjusted earnings came in at 930 million after you strip out some one-off items, which disposal of some investments. Right, so although the net profit actually decreased 10% quarter on quarter, we believe this quarter's earnings to be high quality compared to the first quarter. Right, because during the first quarter, a large portion of the revenue growth was due to investment and trading income. Right, which this kind of thing is usually affected by capital market movements. Right, loans growth are still on track at 2% Q on Q, so we seem to be on track for 8 to 10% loans growth for this year. Right, net interest margin was a surprise at 1.67%. Right, so we expected it to come down a little bit this quarter because China's liquidity situation has loosened a bit. So previously we expected them not to be able to price out on their loans. Right, so it's a positive that it's the highest that we have seen in the last 7 quarters. So the China trade book still remains very robust. Right, they've been quite stringent in the risk management on their China trade book side. Right, fees and commission were largely flat, but the good thing is that wealth management actually grew quarter on quarter by 18%. So the deposits also grew in line with growth, 3% Q on Q. And then the current account and saving account ratio still remains very high, 56%, which is a good signal for them to tap on this when the interest rate start to increase and they're able to price up while keeping their funding costs low. Right, and they're still able to compete in the Singapore deposit space. Interim dividend of 28 cents has been declared, same as last year. Right, and since our last call sector report in June, right, where we expected DBS and UOB, these two pair to reverse in terms of share price performance, DBS has crawled up about close to 7%, right, as of Friday's closing price. So DBS is still a top pick for the banks. We like them for their strong and robust trade finance business, strong deal flow pipeline for investment banking, as well as being in the best position for increased interest rates. So because of strong results, we have upgraded DBS from accumulate to buy, and our target price is revised to $20.50. Now I hand over to Colin to talk about Lantrovision.
Hi, good morning everyone. Today I'll just give an update on Lantrovision, whereby we did a slight revision on our estimates, and the next quarter results is expected to be released by mid-August. Right. So on update on the share price, which has since our initiation in May, the share price has rallied over 15%, and we are. And mainly is I think one of the attraction of Lantrovision is due to its high net cash level, which at 82 million it's accounting for roughly about 48% of the current market cap, and also it's about 6% of its last shareholders' equity. So we do think that the high cash level it's kind of above the level which is more excessively over the level which is sufficient to support its operations. So do raise the possible prospects of a special dividends, right? So other key investment merits on Lantrovision mainly includes its 24-year track record in installing its structured cabling project, as also its global network with global alliance partners, which greatly appeals to MNC clients, whereby they are able to offer the support of their global IT infrastructure through a single source of vendor, right? So other merit will be due to its solid balance sheet with zero debt borrowing, as well as the high net cash, which I mentioned. So some of the key drivers to the growth of Lantrovision, which we foresee in the near term, is will be coming from growing demand for data centers, mainly in Asia Pacific, and this includes Singapore as well, right? And we do see the enterprises will migrate to a faster network speed of either 1 or 10 gigabit per second. So this is mainly to fully take advantage from the nationwide fiber broadband routes, right? Also, we do see that the needs for high quality standardized cabling to minimize any critical system failures from the MNCs, as well as reports that they do foresee that the global structured cabling market is expected to grow at about 4% growth rate leading up to 2020, right? So due to the strong price rally, we revised our rating to accumulate with a new target price of 70 cents. Right. Hello, can you all hear me? Okay, so so just to check on sound check, cause we do have feedback from a participant that were not able to hear us. So right, if everything's okay, then I'll just resume our presentation. Right. Okay, so as I've said, yeah, we have revised our rating to accumulate on the strong price rally with a new target price of 70 cents. So based on current price, this still implies more than a 10% upside. We do as also it comes with an expected 3.2% dividend yield and is still relatively cheap with an implied 7.9 times PE, forward PE or X cash, right, of 7.9 times. So we do believe that there's still further upside to Lantrovision from its current price. Right. Next will be Cityspring Infrastructure Trust. This its asset mainly comprises of mainly City Gas Sing Spring, Bestlink, as well as the CityNet, which is acting as a trustee manager for the Netlink Trust. However, we do just want to bring a highlight on its recent announcement, which is a new 5149 joint venture with Shimizu Corporation, which is intends to build and lease a data center to a MediaCore subsidiary, right? So, for further details on the Cityspring Infrastructure Trust, you can refer to our report, which has been published last week, right? Which gives a quick overview of the business. So for now, we're just highlighting more on this new joint venture, which is basically the data center is expected to be built and ready by the first quarter of 2016. So the purpose of the new JVC is mainly to develop this a tier 3 purpose-built data center to a MediaCore subsidiary, OneNet Singapore, for a period of 20 years after the commencement of the data center, which is expected in early 2016. Right, expected payable fees has been disclosed to be in the range of about 11 to 18 million annually, and we do foresee that Cityspring will probably be looking at 80% cash returns on its equity basis on this new joint venture, and this is estimated to give roughly about a plus percent upside to its average cash earnings, which expected to be kick in by financial year 17 after once the data center is ready, right? So, however, this also signal a possible start for further ventures in the listing of the wholesale data center business, and mainly in Asia Pacific region, as Cityspring foresee that the demand for data centers will outstrip the supply, right? In this near term, given due to the growing demand for data storage as well as the cloud resources that will fuel the drive in data center space, right? Key investment merits of Cityspring Infrastructure Trust will include a steady stream of cash flows for the long term, as well as an attractive distribution yield of over 6.5%, and that's really above most of its peers that's listed in as Singapore and Australia, and that's in the utility industry. Also, it does offer some potential growth that will be realized through investment opportunities, right? So based on the current price of Cityspring Infrastructure Trust, it implies about a 2.1 times price over book, as well as 12.7 times price over cash earnings. But do note that this is a non-rated report, as we do not look for we will not be looking for active coverage on this particular counter, right? Next, I'll hand over to my colleague Yong Kai to share on updates of Genworth Financial.
Hi guys, this is Yong Kai here, the US equities analyst. So today I will just give you a very brief update on Genworth Financial, which we issued a report last Thursday evening. Okay, so just a quick recap. We first initiated a trading buy call at $10.60 last year. Okay, so just fast forward, I'll just quickly go through what the key points. Australia MI IPO was successful, so they generated $500 million of net proceeds for the holding company, which is about $1 per share, and the subsidiary share price has also surged 30%. So what Genworth, the holding company, still owns about 66.2%, so they will benefit from this increase in share price. USMI, they're still benefiting from the US housing recovery story. The valuation, which we are going to use a post-2008 insurance risk book. Okay, this target actually translates to the undemanding 16 times annualized NOI. And to put things into perspective, this 16 times, which is really undemanding, actually doesn't reflect the growing income, the growing earnings from the new insurance return, which is generating about 20+% ROE. At the same time, your legacy losses are actually shrinking. So growing income with shrinking losses, 16 times annualized NOI, this is actually a reasonable valuation for US mortgage insurance. Okay, but what happened? Why did the share price tank 20%? Okay, this is because of these adverse developments of the long-term care insurance, which was announced last quarter. So again, all the segments did it very well. Australia, Canada, US, as well as the life insurance portion. But the long-term care was the only one that underperformed. And this, as a result, the market actually overreacted and caused the share price to crash 20%. They also announced a review for this long-term care to see whether their reserves are adequate. The last time they did it in 2012, they only increased the reserves by $1 million, million with an M. Yet, what happened is that after the second quarter earnings results, about $2 billion, $2 with a B, with a billion with a B, $2 billion of market cap was wiped out. So we think that there's really overreaction, and this could present a buying opportunity. What we're seeing today is that at 0.54 times price over book, which excludes unrealized gains, this is actually a very good downside support. And if you look at the right bottom corner, we actually presented all the per share valuations of the different segments, which looks out to $21. And if you apply a 20% holding company discount, you get $16.80, which is nearly 30% upside from today. And even then, we think it's still pretty conservative, because if you read the reports, we actually have we have kept a lot of the upside. For example, Canada MI today trades at 20% premium above book value, but we're only valuing it at 1 times PB. Alright, so going forward, I'm going to pass you on to my colleague for the next.
It's back to Benjamin again. So just a quick take on Ezion. So last week there's displayed quite strong performance for 2Q in 2Q results. So there's 37.8% year-on-year increase in revenue. But the chartering revenue actually grew as well. Okay, it's because Ezion managed to deploy additional units of lift boat and service rigs. So one of the good things is that net gearing actually fell to 0.98 times. And net profit saw a 25.5% increase to 45 mil. Right, one of the key things we want to highlight is there's a proposed bonus issue, 1 bonus share for every 5 existing shares. So we think that this will help to increase trading liquidity, but we expect some equity dilution post the bonus issue. Right, so our fair value estimate has fell from 267 to 222, right, because of the dilution. Right, one of the key things we want to highlight is that there are more units to be deployed in second half of 2014, and this should continue to sustain its earnings momentum. So there's 6 to 9 more units expected to begin contribution from the second half of 2014 onwards. So currently there are about 18 service rigs and lift boats in operation. Right. Now I'll hand over to our macro analyst Lindsay to talk about Malaysia outlook.
Hello. This is Lindsay. Just a quick update on Malaysia macro. So for Malaysia, we actually downgraded from overweight to neutral weight. On the macro outlook, exports are likely to benefit from improved global economy recovery, and we also see ongoing fiscal and structural reforms, which the fuel cost pass-through mechanism, which are still in proposal level. This mechanism is actually to revise electricity tariff based on international gas price in every 6 months. And then next in line will be the fuel subsidy system to be reviewed. And also I'm sure that everyone is also waiting for the GST implementation in next year, April. Then we also see that Bank Negara actually raised their overnight policy rate by 25 basis points last month to 3.25%, citing that they are trying to rein in spending, which has fueled consumer debt as well as inflation, and to mitigate risk of broader economic and financial imbalances. But this also feed to cost pressure, burdening Malaysians who are actually already struggling with mounting cost of living. Nevertheless, we expect domestic demand and investment to remain resilient. Strong growth will help to cushion the impact from interest rate hike on consumer spending. Just to sum it all, we downgrade to neutral weight from overweight on cost push inflationary pressure, elevated credit risk, as well as a slight pullback in growth in the second half due to dampened consumer demand, and as well as base effect wears off. But we remain optimistic on sustainable growth. Just a snapshot on KLCI. As well as for those who are interested in investing in Malaysia. So these are the mutual funds as well as ETFs that proxy Malaysia. Moving onwards, I'll pass the presentation to Kenneth, who will talk about Sodastream.
Hi, good morning all. Here's an update on Sodastream. Okay, so Sodastream recently announced their second quarter results. So Sodastream is an interesting animal. So there's always a lot of extreme news about this, good and bad. So let's talk about it. Okay. So basically, Sodastream, their diluted EPS, okay, it was down 28% year on year. Okay, this actually beat the analyst expectation according to Bloomberg, because the analyst expectation was actually very pessimistic. Okay, hence there was a small surge. Okay, from I think 30 plus cents to 34 cents. Okay, but let's look at the whole picture. Now, we noticed that the US sales, as guided or expected, has picked up 18% quarter on quarter, okay? But this is still 14% lower than last year, okay? Because of this, we do question, or we have to give a lower guidance for this year because of the US slower than expected sales. Gross margins are down as expected, okay? And that's because of product mix and the inventory write-off because of the US inventory overhang, because they overstocked themselves basically last year in December. However, excluding the US, which is turning around, we note that essentially Sodastream is doing well everywhere else. Ex-US revenues up 20%, refills up 20%, flavor units up 20%, and soda makers up 4%. Okay, so because of slower than expected US sales and slower than expected sorting out of the inventory overhang, the management has lowered guidance. So it's from 15% guidance, they've dropped it to 5% for revenue and a 5% drop for net income. Okay, now at the same time, so basically, Sodastream is doing well globally. They seem to have entrenched themselves globally, but as of now, they're still sorting through the US problems, and they're still trying to find a solution for enhanced demand creation for the US. I guess you can say that they're still trying to figure out the US market in that sense. At the same time, right, BDS news or movement has becoming recently in the news become more negative. So the boycott, divestment, and sanctions. This is due to Sodastream having one of their main primary manufacturing plants in the Gaza Strip. So we hear that the Soros Fund, which originally bought at $40 a share, and some other international investors have actually pulled out over pressure from the Palestinian activist BDS movement. Okay, so the BDS movement risk was more negative than expected. Okay, however, here are the small victories this year and some positives next year. So victories are, for example, here's a sample. Samsung is deciding to expand their distribution of carbonated fridges powered by Sodastream, which is great. Before, they were only in 1 or 2 models. Now they're expanding it to all the premium models. KitchenAid is now has shipped off their to retailers just this quarter from in the US and Canada. Okay, and Sodastream is also now the official gas suppliers for Tefal's home soda makers. So as you can see, Sodastream is actually entrenched itself in the sense of its gas distribution system. So even if they do not sell their own soda makers, they are already the official gas suppliers for other brand models. Okay, their 200-man factory in southern Israel will be fully operational FY15. So management is expecting margins to improve by 2-3% at that time. And right now, management is expecting better sales as they refocus their demand creation strategies in the US now. Okay, so what's the investment actions? Okay, so the weaker sales, especially in the US, raise into question the US growth profile. And we have to await the efficacy of their demand creation efforts, right? We're not sure how successful their US new marketing will be. We'll probably see it end of the year to FY15. More negative than expected boycott news flows decrease the M&A attractiveness. So we have to decrease a little bit of their M&A premium. The probability of them being an attractive M&A target has diminished because of the negative news. We have to see this improving first before we add back the premium. Okay, however, Sodastream is still the undisputed leader in redefining grey market and has entrenched their position globally, especially for their gas distribution system. Even with the competitors coming in, we do not expect these competitors to actually use the same system as theirs, because it takes a lot of time and equity to actually build up this gas distribution system, and that's the reason why KitchenAid and Tefal and Samsung are all being powered by Sodastream right now. Okay. However, taking this all into account, we downgrade to neutral due to lower growth assumptions. Okay, and we decrease M&A chances. Target price of $35 is just based on 19 times EPS. Sorry about this chart here. Okay, we have formatting overhang, but the summary is this. So in America, year on year, there's a 14% drop in revenue sales, 14% drop. But as you can see, for Western Europe, Asia, and Central Europe, Middle East, Asia, we see basically double-digit growth, especially in the Middle East, Asia area here. Okay, in terms of product segment units, okay, the three segments: soda making, CO2 refills, and flavors. You see that yes, soda making has been decreased year on year because US sales slower than usual. Okay, and also don't forget, at the same time you have other companies doing their own soda makers, right? But don't forget that these soda makers are powered by Sodastream, and that's why you see the CO2 refills still growing year on year, 17%. So we think that the CO2 refills is, in the end of the day, that's the most important, because Sodastream is essentially a CO2 distribution company. Essentially, that's what their entrenched position is. So even though there's some positives here, we think that for FY14 we will have lower growth assumptions and improvements. If there is any, we'll probably see most of them only in FY15. Yep. Okay. Okay, next pass you to Joshua, who'll talk to you about the macro picture.
Hi, Joshua here. Okay, so we've had a bit of a sell-off in the markets. So I guess you guys may be wondering, is this a correction or start of the bear? Well, in our opinion, it's probably a correction amid a bull market. So what was this sell-off triggered by? Actually, not any real macroeconomic weakness or anything, but rather accumulation of geopolitics: Ukraine, Gaza, Iraq, Ebola. It's the most deadly outbreak yet. Portuguese shock bank losses and Argentinian selective default. And perhaps just about every strategist on the street, including ourselves, are calling for a correction. So maybe just an accumulation of events. And we've had a very nice 5-month non-volatile bull run on the S&P. Okay, so if you look at the fundamentals, right, we think it's more likely a correction amid a bull market, right? So we still think we are in a bull market. US first quarter saw weak output and corporate profit, but other data suggests a rebound in the economy. Basically, capital good and manufacturing new orders are rebounding, resurgent employment and wage growth, declining unemployment insurance claims. The Chinese economy is also rebounding. Eurozone still showing collective expansion despite pockets of weakness and inflation and deflation risk. Japan economy is slowing with the sales tax hike, but still in expansion. And the rest of Asia is humming along, with India, Indonesia, and Thailand looking forward to structural reform. Right. So on the whole, I think we still see the macroeconomic data as positive. Now, also bonds relative to stocks are extremely expensive, with bond yields at record lows. So it continues to make stocks a relatively more attractive option, especially with a growth uptick and inflation having more upside than downside risk. I think the best place to be is stocks. And especially in a rate-raising cycle, I think the bond sell-off would be, the rotation out of bonds would be even greater into stocks. Okay, so we advise people not to panic. I think you can use this correction as a opportunity to accumulate stocks. Okay, any more macro risks out there? I think there is some Eurozone deflation and geopolitical risk. I think the biggest risk is that Russia cut off the natural gas supply to Europe, which would definitely induce a severe recession there. But then again, Russia does need the income from natural gas. Okay, so the risk of that, I think, is still low at the moment. Now, China's real estate bubble and shadow banking system is still a macro risk. However, it is a widely viewed risk. So when every strategist or economist is looking in the same direction, sometimes, especially for systemic issues, it's very unlikely for it to implode. Okay, I'll push you on to Kenneth, who will talk about some support targets.
Everyone, Kenneth again. Okay, so as Josh mentioned, we don't have to panic yet. Although some might see last week's action as a reason to panic, but let's just talk about what we see on the technicals. Okay, so last week, we had some percentage drop. I think the Dow Jones dropped 300 to 400% altogether, 300 to 400 points altogether. Okay, but here's the chart of the S&P. This is the weekly. Okay, so technically we see a few things. Okay, one, finally the MACD has crossed down, and it occurred on lower breadth. Okay, I'm using our trusty RUT SPX, right, to show you that lower breadth. So in other words, the Russell is performing worse than the S&P on this cross. So this it just tells me the probability for a bit more of a correction is in place. Okay. So unless a sharp reversal candle appears, further downside is likely. What I mean by sharp reversal candle is something like here in April. Unless you see a reversal this week, sharp one like this, or if you see something like this in February, like a big reversal. Unless you see these two, I'm going to expect a second round of selling, and hence the second round of selling will be likely to be like this. I'm going to just go to the next slide to show you. Okay, so right now here, this is an annotated graph of all the corrections we've had for the last 3 years. Okay, so essentially, this is a very big support zone here, and this particular support zone also is in line with a 7.1% correction. This 7.1% correction in magnitude is very similar to what we have here in October of 2012, okay, and April to June of 2012 as well. Okay, so we think that the likely short-term target is between this zone here, 1850 and 1950. All right, so we think based on this extended move over here, that the correction levels would be similar to this, or in between. Okay, unless there's even more unexpected bad news, a sudden surge of unexpected bad news, Maybe Ebola, anyone? Okay. If not, right, then we expect a normal correction to be on this magnitude. However, right, a convincing break below 1850 implies a downside target of 1750. So if this support zone does break, okay, this would be a high probability target right now, 1740. And as long as the macro conditions are still in place, meaning great looking yield curve, low interest rates, etc., this would be a good place to pile on, or rather just to reinvest. Okay. Here's something for you, something interesting for the RSI. You'll notice that for all the corrections that we had so far, okay, so basically what signs can we look at to determine when this move here is starting to wane and turn around again? Okay, so here are just some interesting patterns for you, which is we can see from the last few corrections. You can see that essentially every time the correction, especially these two corrections, right, when these occur, you usually see a double dip, okay, on oversold region for the RSI, followed by a breakout. See a double dip here, double dip here. This particular one was divergent, okay, and for most of these corrections, you see a double dip on the RSI. So this is just based on patterns of the last few corrections, and I would say just take a look out to see when you have a double dip. The first time it hits into oversold region might not be the end of the correction, but seeing a double in the RSI does warn you that maybe it's turning around. Now at the same time, going back to this chart over here, remember that we are likening the correction that's going to be occurring similar to this one over here, right? The 012 October correction. You can see for this correction over here, VIX levels were roughly 22.5 onwards, right? Now, since we are assuming it's likely going to be this one, unless you see a sharp move up here, a good time to know when it's getting really oversold in this correction is using the VIX levels. So here, right now we are at 17 right now, and when it gets around here, that's when we should re-look at the market to see whether there are signs that the correction might be turning. Okay, so these are the two things to look at, the VIX and perhaps the double dip in the RSI. Okay, what about STI then? Well, for the STI, we note that 3200 to 3300, this is the support zone, and very, very likely we're going to pull into it. I know today that there is today's market is negative, so we're probably already almost there anyway. So definitely a pullback to this zone is possible, especially if the US continues its correction. Okay. Now, depending on the length and magnitude of the US correction, right, it may pull on further. Okay. Now, obviously, if the price can actually consolidate in this region here and stay in this zone and not break it, right, the longer it can do that, then that implies actually a upside target to its 52-week high of 42.65. Now, if this gets broken, if it does, then the next support zone, likely key support is around here, this level here, which is around 31.30. Okay, so if the US correction is maybe it doesn't continue long, or it's not steep, the price may just go into this zone here. But if the US correction is long, maybe it lasts a month or maybe more than that, it's possible to break this and come down to this level over here. And then because we are still in a bull market, this would be a very interesting place to relook at the market and see whether it's a good time to get back in. Okay, that's for the STI. Before I pass it to Ben, let me just answer one Sodastream question, because I'm online now. Okay, the question is for US, right? What corrective action will management be doing? Okay, the question, I'm going to paraphrase it. I'm assuming that what can they be doing to increase sales in the US, right? So right now in the US, if essentially in the end of the day, when you're selling drinks, when you're selling product, right, brand management is very important. And every country actually has they have a different marketing strategy for every country. Okay, for example, in Finland, Sodastream actually focuses on environment, because Finland people are very pro-environment. In France, their marketing strategies focus on fun and enjoyment. And in Germany, their marketing is is focused on this thing called scalping, which is basically the ease of going to the market and just buying small gas tanks rather than big bottles of soda water. So as of now, they are trying to reimagine, or rather refocus, what their marketing strategy is for the US customer, and hence they have a new focus on that now. And yeah, so how successful they'll be depends on the effectiveness of the new marketing strategy. Okay, so I'm gonna hand over the mic to Ben, who's now gonna talk to you about Heng Offshore and Marine.
Hi, it's back to me, Benjamin again. Right, so Heng, we actually initiated on this 2 weeks ago. So 2 weeks ago, I gave a brief summary slide. So as promised, this week I'll be going into more detail on this counter. Right, so this just a brief overview on Heng, currently trading about 8.2 times PE. Right, market cap for 180 mil. So coming to the share price went down a little bit. So there's quite a bit of selling pressure over the last 1.5 weeks because the lockup period for the monetized shares has been over. Right, so the IPO on January 22nd, after July 22nd on the T+1, there was quite a bit of selling pressure, right, from the guys who are holding the lockup shares. Right, so as a picture and as well as a name suggests, these companies involved in the offshore and marine industry. So just to share with you guys, this is one of the plant visits that we did to see them discharge in a semi-sub that's from Transocean, right, and drag it into Keppel Fells to be serviced and repaired. Right, so some company background give you a bit more flavor on it. Heng is an established integrated O&M value chain services provider. The company itself is strategically located in Singapore, which you all know enjoys a very good reputation of having one of the best and thriving offshore and marine industry in the world, which is why so many O&M counters actually choose to list over here. Right, Heng itself focus this point is a one-stop products and services provider for the O&M value chain. My customer base is quite broad, stretches over 25 countries, and they are quite some of them include major offshore drilling contractors like Transocean, Seadrill, Noblecorp, Shell Drilling, as well as Hydro Marine. So Heng itself has been around for about 40 odd years, and their relationship with customers like Transocean spans over about 2 decades or so. So Transocean and Seadrill are one of their regular customers for their services. Right. The business activity itself, we will split into 2 main portions. One of it is more related to the offshore rig side. So they have offshore rig services as well as supply chain management. Right, and the other portion will be on vessel sales and new build. Right, so I'll go in more detail on the offshore side. Alright, so offshore rig services, there are 4 main branches of activities that they do. First one is they construct and fabricate some components for jackups, drill ships, and semi-subs. Right, their portion, they are involved with some of the subsea items like installation of offshore production modules and systems. So looking at blow-up preventers and risers and so on. Right, and then for this site where Heng is also quite well known for being a floating car workshop kind of thing, which they do afloat repairs and maintenance for certain rigs and vessels that get into accidents or are damaged, right, or need servicing. And on this side, they also do some supply of offshore drilling equipment, which they purchase for their customers and sell them later on. Right, so these are some of the photos that they have provided us. So you can see for here, this is fabrication of a drill floor, the flooring for a jackup rig. And then for this, you can see that it's a vessel which the hull is damaged after it got into a collision with another vessel. So Heng was called in, right, to service and repair the ship out in the water to get it up and running again, right, which requires a fast and quick turnaround time. These are some of the pipings that they order for their customers. And you can see here, they use heavy lift equipment to pull and bring the risers into the yard facilities to be serviced and maintained. Right. So for supply chain management, is also under the offshore, one of the main business branches. So they have a fleet of tugs and barges. So sometimes they do charter out their offshore support vessels as well as heavy lift equipment for their customers. And on this end, they do some warehousing and provision of logistics. So sometimes they also do crew change management for the crews that are aboard the offshore rigs. Right. So for this other part of the business, they do some vessel sales and new build. So as the name suggests, they do some new building of vessels. So over here, this was one of the projects they did in 2010, where they built a pipe laying barge for one of the Australian customers. And then they also purchase and refurbish certain vessels to sell it again to other customers. Right, so I'll move on to the key investment merits. Right, for us, we identified 4. So first one will be asset-light business with high returns and strong free cash flow, operating cash flow. The other one will be on the macro side, where global fleet utilization rates are high, as well as the global rig fleet is aging. Right, so it's a positive for demand driver for Kim Heng services. Certainly, the key repeating catalyst is what they're going to do with the IPO proceeds. So, which is to undergo expansionary plans and kick in their capex cycle, so they have more capacity to take on large turnkey projects. So currently, Kim Heng is trading at about 8.2 times PE, about 10% discount to its peers, right? Despite its superior returns that it has shown over the last few years. Right. First up, asset-light business model, because it's in the services industry, different from guys who actually build assets. So their key assets are only tugs and barges. Some of them have already been fully depreciated, right, as well as holding some heavy lift equipment that's required for their work. Inventories are kept at a very low level, right? So currently what they do is that they only purchase components just in time, right, when their customers place orders. Right, that's why their gross profit margins and net profit margins are actually quite high, resulting in them having very superior returns on investor capital. So if you look at the revenue analysis, which I'll break this down more for you later on, during FY11, FY13, there was less contribution from the vessel sales and new build portion, right? Which we like that, because if you take on more risk on the balance sheet when you undertake new build projects. But you look at the yearly net profit, FY2010, right? You can see that it went on a net loss. That was because of a few factors. First of all, there was an inventory write-down. Because of some of the inventories became obsolete, but which was subsequently returned back over FY11 and FY12. Right? They also had a impairment of a receivables account from Australia. Right? During this year, they built the pipe laying barge, so there's a percentage of completion for revenue recognition. So because of that, quite a lot of cost was captured in this year, but the revenue was only subsequently recognized in FY11. Okay, so here's a bit more background on their revenue and net profit trends. Right, so the gross profit margins over the last 2 years quite consistently above 40%, right, about 42 or 43%. And net profit margin, right, is about 20% or so. Right, so they are able to command such margins on their contracts, right, largely due to them having a very long track record with their established customers. Right, they're able to turn around on some of the key projects very quickly, because some of these contracts, when they come in, right, they require a couple of weeks to maximum of 2 months to turn around the project. So for them, they are able to, because of time requirement, they're able to charge a higher pricing on it. Right, so we look at the return on equity and return on investor capital being quite superior over the last 2 years. So of course, this will trend down since there's an influx of equity after the IPO. Right, free cash flow and operating cash flow has been robust and positive since FY2010. So now they're embarking on the capex cycle. This is over after 2 years, the free cash flow growth should expand rapidly, and this signals a good return for increasing shareholder returns, like perhaps in the form of dividends. Right, so if you do a peer comparison, if you look at this table here, right, this is the small mid-cap Singapore space for the offshore and marine players. So you can see that for Kim Heng, both in terms of return on equity as well as investor capital, is much superior to its peers, yet it's trading at a discount to quite a number, to the average. Right. Now we look at the next portion, which is on the macro side. I draw attention to this table. So you can see that for the global offshore rigs, fleet utilization remains healthily above 90%. Right, and the total supply of offshore rigs are also, of course, increasing as well as more rigs are getting built, right, and there's an increasing number of the rigs getting contracted, right, of course, because due to the high utilization rates. So the combination of these factors, these are key drivers for Kim Heng's repair and maintenance services, which I will elaborate a bit more on. So again, if you look at the breakdown of different types of rigs, right, the semi-subs, drill ships, the harsh condition jackups, as well as Southeast Asian jackups, they are healthily above 90%. Right, and if we look at the aging profile, right, for the global jackups above 30 years, right, there's about 46% of the total count that's above 30 years. And for floaters, which are your drill ships and semi-subs, they are about close to 30% that are over 30 years. So since the global fleets are aging, but utilization rates still remain high, right, that's my opinion is that the rig replacement cycle might not kick in yet due to the high utilization rates. But this means there's a need to repair and extend the useful lives of rigs, right, to be able to take on more contracts. And then, of course, oil prices have been sustainably high above US $100 per barrel, right? So this is a key driver, from what we understand, to deploy older rigs to drill in marginal oil fields, right, to do enhanced oil recovery. So this kind of activities usually need sustained high oil prices to embark on. And again, they prefer to use older rigs for this kind of activities, right? So all this becomes key demand drivers for repairs and maintenance services, which is what Kim Heng is good at. Right. The third one will be the key re-rating and catalyst that we foresee and are optimistic on going forward. So they have quite a lump sum of money from the IPO proceeds. So they're embarking on expansionary plans. So part of this will be enhancing their yard facilities and expanding their fleet of tugs and barges. Right. So what this does is to help them to improve, right, and build new fabrication engineering workshop, which will improve their capabilities as well as to take on more complex and higher margin projects. Alright, so they also want to improve their quayside jetty and wharfs. So a lot of their projects require enough space and yard capabilities, waterfront space and yard capabilities. So by these improvements, it means that they will free up some bottlenecks and help to increase capacity for taking on larger types of projects that will be higher margins. Right. And another thing is they're potentially acquiring a subsea service contractor to expand their subsea capabilities. Currently, right, they are really underdoing some subsea projects, but it's more of servicing subsea items in their yards. So if they can acquire a subsea service contractor to complement their suite of services, we think this will be a good match in terms of their business. So of course the key thing is to look out for how accretive this acquisition will be, both operationally to their business as well as to the earnings. Right, so we hope that this will open up opportunities for them to take on large turnkey projects like rig reactivations, conversions, and refurbishment. So for example, to reactivate a jackup rig, the total revenue that's booked is about 20 million. So currently their revenue is just about touching 100 million. So you can imagine that by taking on just one rig reactivation contract, you'll boost the top line by more than 20%. So when it flows down to your earnings, you're looking at about 10 to 15% increase. Right, so moving on to our forecasts and valuations. So about 20% of their revenue actually comes from chartering and towing. Right, and the rest, 80%, right, comes from the offshore rig services, which is correlated to how many rigs they actually service. Right, so this part I would like you to pay more attention to. Right, so last year they serviced about 68 rigs, and then they break it down in different tiers of value. So of course, as Kim Heng expands, hope that they are able to take on larger types of revenue type of service contracts in terms of servicing rigs. So we look at the core business-wise. Okay, for the offshore rig services and supply chain management, which is the core business, it actually has been growing quite healthily over the last 4 years. Right, the one that's causing some volatility is actually in the vessel sales and new build, right, year-on-year wise, right, which is good that they're trimming down on this because they're taking on less risk in their balance sheet. Right, so therefore, we have forecasted for rig service, the total rig count to increase by 3 and 8 in FY14 and FY15, so it's about 5 to 10% respectively for each year. Okay, this is because of expanded capacity, they're able to take on more contracts, and profit margins, right, we assume it to be quite stable over the next 2 years or so. So again, if you do a peer comparison wise, right, draw attention to Kim Heng versus the immediate peers like MTQ and Mancast, which are both doing the service, quite similar in terms of doing some form of servicing for oil rigs, similar market size as well, right? Their returns are definitely inferior to Kim Heng. We draw a comparison of both ROE and return on invested capital, whereas Kim Heng is currently trading at more than 10% discount to its peers, which we believe it to be unwarranted. Right, so therefore we have initiated 2 weeks ago with a buy call, right, of 11 times FY14 PE. So our target price is 33 cents. So I understand there's a bit of share price pressure now. So this represents about 30% upside currently. Now I'll move on to this part, which might answer some of the questions that you guys have they are asking. Right, so draw attention to the key risks. One of which is the leasehold that they have over their yard facilities. So 2 of the yards are leased from JTC. So one of the key things is that, of course, you need your yards to be able to continue to work. So currently they are negotiating with JTC to extend the leasehold over the yachts, and I think if I remember correctly, the leaseholds runs till 2019, so they are looking to extend the leaseholds, right, based on certain investment criteria that they are required to spend on the yacht, right. And then for this one, which is the most important portion, right, Kim Heng by itself, right, is in nature a service provider similar to companies like MTQ, right. So when you're a service provider, you do not have order book visibility like asset builders like Keppel and Sembcorp, which visibility can be run up to 2019 or so, more than 5 years, right? Sorry, 4 to 5 years. On the other hand, these type of contracts are usually fulfilled and completed within a couple of weeks to 2 to 3 months, right? So order book, I won't really say is present. It's more like a commitment that the customers have with you that you might be able to foresee over the next 3 to 6 months. So as of the last quarter, when they disclosed they had an order book about 40 million, right, which is rolling, and of course, there's a visibility and recognition only coming 3 to 6 months later, right? So of course, along the way, ad hoc project will be added as well. And then remember that 80% of the revenue actually is dependent on the number of rigs that they service. So the number of rigs that they service is also dependent on the timing of the rigs that arrive in Singapore. So some of the rigs actually might be coming from the North Sea, come all the way into Singapore to be serviced, right? So sometimes the transport, the towing might be delayed. So when you look at this, the timing of the rig arrival might be unpredictable, right? But of course, the commitment is already there, right? So therefore, Kim Heng usually has some sort of near-term volatility or lumpiness in terms of revenue recognition if the contracts do not flow in for the current quarter or the current period. Right, so sometimes it might spill into the next financial year, or sometimes it might spill in the next few quarters. Right, so this is the key risk that we need to assess, right, and investors need to be comfortable with this, right, that we might see near-term volatility. So with that, I'll leave you with the last slide, summary of the key investment merits, and please feel free to ask more questions. So yeah, I'll answer some questions. The person covering Kim Heng is me, Benjamin, right. And then, yeah, there was a profit guidance announced on last Friday evening at 5:38 p.m. Okay, so again, I'll draw you back to the key risk before that, which is what I mentioned about in my previous report 2 weeks ago as well. So this is what we have been seeing. We've followed up on the company on this. So as what they've also explained, right, for this quarter, right, some of the high value rigs that they're supposed to service were delayed by their customers. So it might arrive in the next quarter, or definitely in this half of the year. So the order book actually did grow from the previous amount of 40 million. It's just that the revenue recognition could not happen in the 2Q of 2014, right? So as a result of that, their revenue has actually grown for the first half, year-on-year wise. All right. However, the amount of contracts that they took on for the last quarter was actually slightly lower margins. That's why the net profit that we were going to see will be below the first half of the previous year, right? But in terms of revenue wise, I think it did grow, right? So for that, we are waiting for the results released on the 11th of August, and after that, when we have a chat with the CEO and CFO, we will give you guys more update on that, right?
Joshua here. I'll just handle all the macro questions first. Okay, so there's a question here saying that inflation having more upside than downside risk, the best place to be in stocks is what we said. So the question is, may I ask if there's an increase in interest rate, would it be negative for the equity markets? Okay, heard everyone in Wall Street is worried that Ms. Yellen will increase the interest rate and equity market will pull back. Okay, so in the history of rate raising cycles, actually, it depends whether the market expects it or not. So if the market expects the rate raising to happen, then it's quite likely if there's any pullback, it's going to be very shallow. Okay, and actually, when the whole interest rate raising cycle begins, that is that also coincides historically with a very strong bull run in equities, okay? Because portfolio managers will be dumping their short-dated bonds and buying stocks. Okay, so contrary to popular belief, rate-raising cycles do not mean the beginning of bear markets, especially not in the US, okay? It may occur in some emerging markets where you increase, when you go on a rate-raising cycle, then the market tanks. However, that's not the golden rule in developed markets. Certainly not the rule in Singapore. Okay, so I think if the market expects the rate raising and it happens, then maybe very small pullback and then start beginning of another new upcycle. If it doesn't expect it, then maybe the pullback could be a bit deeper. But still, I think it also means that so long as the economy can withstand it, it's better to be in stocks than bonds. Okay, so there's another question here. Seems some rotation of funds out of US and Europe to China. 8 shares. What's the impact on Singapore market? I think there is no tight connection between the two. However, I will say this, that the rotation out of US and Europe is probably going to all Asian markets, right? Not just China, not just the H-share market, this is because G3 has had an outperformance already. Globally, we're still in a bull market cycle, so portfolio managers will be looking at what has underperformed, and that will probably be Asian markets. Okay.
Hi, there's a question noting that Cityspring's price over book is 2.1 times, which is higher than most infrastructure trusts. And comparing to K-Green, which is only about 1 times PB. Yes, this is based on the price over book. Yeah, Cityspring is higher than many other peers. Its current price over book is in fact closer to the peers that are listed in Australia. However, let me just share on some of the key differences between Cityspring and the K-Green Trust. Cityspring mainly has typically they like most other utility, they look for a very steady stream of cash flows, so it would be more reasonable to value the utility stocks based on the cash flows that's generated from its assets. For Cityspring, it actually has a pretty high leverage to boost its ROE, whereas for K-Green, it in fact has zero borrowings, and hence its ROE is in fact pretty low, about the 2.2% return over equity. Another thing to note is that K-Green's distribution is over 90%, so hence you will see that there's a pretty there will be a slow accumulation on its cash, whereas for this Cityspring, the distribution is in fact is lower, roughly about 70 to 80+%, allowing it to have a faster accumulation on its cash, and that may indicate that it will be in a better position to capitalize on further investment opportunities.
Hi, a quick question on Valuetronics. Question is, how do you see Valuetronics? Is it worth buying at the moment? So, okay, let's look at the fundamental picture. Right now, based on just our very, very conservative forward earnings, which is actually more conservative than every other report out there, our PE right now is about 7.5 at the present price. PEX idle cash is about higher than 6.5, around there. And PE X cash, if it's all X cash, is 5.5. So based on all these three measures, right, we do think Valuetronics is cheap. The question is it worth buying at the moment? That depends on the market sentiment, basically. The company itself, I think, is good value still. Remember that I gave a target price of 60 cents after dividend, so right now it's at 50 cents. So it's still undervalued, but I guess traders might want to be a bit cautious because of the starting of a correction in the US, and that might continue for a while. But other than that, I think Electronics is a good candidate for accumulation. Thanks.
Benjamin, I'll take the questions on Kim Heng. So this question for Kim Heng is currently there's a sell down initially due to a substantial shareholder pulling out. All right. As of the sell down portion, no one has shared with us yet on the company. Not shared with us on who were the shareholders that pull out. From what we understand, the main shareholders are the family itself, Credence Capital, the private equity firm that's about 17 to 18% stake, as well as Double Happiness, the other fund manager. There were no sell down on their side. Right, so in terms of disclosure-wise, we do not know of any substantial shareholders that pull out. Probably just a couple of guys, right? They were in it pre-IPO, right? And for Kim Heng, we are using PE for valuation, not recommending them based on PE. But we like Kim Heng because of their business model, because it's a stable play in the offshore and marine sector, because of the nature of being a service provider, right? Not asset builders. And on top of that, there's a potential growth story from their expansionary plans, right? So this is more of the investment merits that we're focusing on, right? The PE portion is more of the valuation side that we're looking at, right? Based on the fact that they are trading at a discount to its peers that are in a similar business, which are MDQ and Mancas.
Alright, this is Yongkai here, the US equities analyst. There's an interesting question about what potential stock might have some, about if there's an Ebola outbreak, which stock will benefit. Currently our department, we don't cover any stocks that might benefit from this, but something speculative that just for FYI, there's this Canadian pharmaceutical, Tecmira, ticker TKMR. It actually has this vaccine that is on the phase 1 trial that actually granted the fast track status from FDA. Okay, so if there is an Ebola outbreak, there might be some sentiment shift that benefits the stock. But I just want to emphasize that it's only at the phase 1 trial and was recently halted because the FDA required more information. So this it won't be producing not in the next 1-2 years or so. Yeah, you can only benefit because there's consumer sentiment shifting to it. Yeah, again, it's Canadian pharmaceutical, Tecmira, the ticker TKMR. Thanks.
There's a question on SGX, Benjamin here. So I think for our side, no one has done any technical analysis on SGX, but let me give you a little bit of more background. So for the quarterly results wise, it was pretty decent. Of course, the correlation factor between the securities daily average traded value and the share price of SGX is very high. Right, so over the last 1 week, we saw that the volumes and the average value has actually went up quite a bit. But I think in fact last Thursday it was 1.7 B. I think it was the highest daily amount that we have seen since about 1 year ago. Right, on top of that, last Friday it rolled out a couple of measures which I think in the long run wise it's quite bullish that like these are potentials for increasing trade volumes, which of course will help to drive up SGX share price. So yeah, these are some of the fundamental factors that we have. But again, on the TA side, we do not have any views on that. Thank you. Alright, so I think today was quite a long session. So we'll end the presentation, the weekly webinar here today. So thank you very much for attending, and we look forward to you tuning in again next week. Thank you very much.